Hi, everyone, and welcome to our session with Refinitiv Labs, one of our Learn-IT-All-Labs webinar sessions. Today, our topic is going to be liquidity measures, where we're going to be hearing about a project by one of our senior research and data scientists from Refinitiv Labs, New York. A couple of housekeeping measures. We're going to have polls to keep this interactive. We're going to do Q&A at the end. And we're also going to be recording the session for any of you who want to go back and re-listen, or any of our colleagues that couldn't join us today. A quick overview of the agenda today. I'm Natalie Samarco. I work in market development for Refinitiv Labs. I'll be doing an intro to Refinitiv Labs and then a short introduction of what we're trying to solve for with relation to liquidity. And then we're going to invite Joel to speak about the project he's working on related to liquidity and finish up with Q&A at the end. So who are our speakers today? I just introduced myself. I've mentioned Joel a couple of times. He's our illustrious data scientist in the labs in New York. And we're excited that he's going to be sharing his information and his research with us today. So let's jump right into what is Refinitiv Labs. So Refinitiv Labs, as the innovation arm of Refinitiv, a large data company, we're in 3 locations across the world, and we're a very cohesive, well-built-out lab. And so we have full-stack engineers, we have design experts, we have ecosystem managers, researchers, and we're quite agile in working across all of these geographies. What you see before you gives you an introduction of the breadth and the depth of the data that Refinitiv possesses. And so we in the labs get very excited about this because we can use this for analysis, we can build analytics, we can use it for machine learning, and that is what our customers use it for as well. We're very proud to know that this rich base of data is exceptional for machine learning because we try to make it as clean as possible so that there's less data wrangling for data scientists and machine learning engineers. So this is something that we in the labs are very excited about. Additionally, in the labs, we're very aware of some of these foundational technologies that are driving our industry. And so this is a handful of technologies that we in the labs focus on. It includes especially AI, machine learning, cloud technology, analytics, but then we are exploring uses of alternative data sets, which we know in financial service industry, many companies are looking at to see if they can gain insights from. Taking a look at our ecosystem, the ecosystem is becoming more and more important to data science teams and innovation arms. And we work with large and small companies alike. Now, a note about how we interact with cloud providers. We in the labs have about, probably 15 to 20 projects a year, hypotheses that we work on, that we focus on and hammer in on. And we like to think of ourselves as cloud agnostic. According to the project, that's how we choose a public cloud provider. So we like to use the best tools possible available in the industry to help support what we work on. So we're excited to use all types of cloud environments and cloud technologies as we progress in our project journeys. Additionally, we partner with universities and associations, especially Imperial College in London, MIT here in the United States. And in Asia, we partner with DCamp, which is a very large hackathon-type organization that runs challenges focusing on AI and machine learning. And hand in hand with our partnership in universities, we also conduct our own research, and all of our projects have a white paper attached to it. And these white papers are also available on refinitiv.com. And there's a breadth of white papers available on some of the projects that we're actively working on, and all of our past white papers as well. So at this point, we're going to do our first poll with the audience. Does your firm currently have an accurate view of market liquidity? Our topic today. I'm going to give us a couple of seconds to answer this and see how it pans out across our attendees today. So as we know, we're living in new times right now. We're living in what we're calling for this session COVID times. So as you think about the times that we're living in, do you think your company has an accurate view of liquidity in the market? Give it a couple more seconds. Let's see. All right, very good. So most of the participants say yes, and then some of the participants are unsure of whether their firm has an accurate view of market liquidity. That's fine. We wanted to take the temperature of who's in the audience, and it's nice to know that liquidity is something that is top of mind for many companies. In moving on, we're going to talk about what is the problem we're trying to solve for. What is liquidity in the current market? And as we think about this from the Refinitiv Labs perspective, we have thought about what has happened in COVID times. What are the trends that are happening, at least in the first half of 2020? And liquidity in COVID times has seen the trend of moving from passive management to active management. And this is in large part, not solely, but in large part due to the volatility that we see in the market. So traders are working not merely off fundamentals, but of price behavior as well. And so the volatility in the market is a large factor in that. And then additionally, we think about what are the analytics that we presently have and what's needed in the future, because analytics, of course, as many of us know here, are needed to make those quick trading decisions. So what are we doing in the labs with this? Of course, we're looking at analysis of the data. I brought up that data slide that showed the breadth and depth of Refinitiv data. It's rich data. We have the price behavior. We have the limit order book, which Joel will talk about in his presentation. So we're analyzing the data. And then we think about what is the organization of this data from an infrastructure standpoint, given the large volume of data that is coming through. And then additionally in the labs, we're continuously developing analytics and tools to add to the trader's toolkit for future use. And with that, I'm going to thank you, and we're going to pass it off to Joel so he can describe his project. Joel, take it away.
Yeah, thank you, Natalie. Let me just skip to the next slide. So my name is Joel Siebold, Senior Research Scientist with Refinitiv Labs. I'm going to not assume, well, I'm going to assume that most people are familiar with market data. I'm going to go sort of quickly through the first set of slides where I'm describing aspects of market data that we're working with to help us understand liquidity. So my apologies if I'm going to go too fast here, but for time, that's what we need to do. So anyway, we have two streams of data, of market data, live streams. So one represents trades and execution or executions, and these are the basic observables of the market. So you have a timestamp, a security price at which the trade transacted, and the size and volume of each trade. And you can see timestamps are out to the nanosecond here. Trades are the result of an aggressive move by a market participant where information has come into the market, or they feel more information has come into the market, and they need to move quickly using market orders, where you're guaranteed an execution during normal trading, but not necessarily the price. In addition to about a dozen U.S. exchanges, we also have trades from so-called dark pools, and I'm not going to go into a lot of detail on that, but they're an important player in this. The second stream of data is coming from order placement, we'll call that a quoting stream, and this is more along the lines of, well, I want to guarantee a price, but I may not be guaranteed an execution. It depends on how the market is moving, and generally submitted by more patient traders. And you can see the data is a little bit more complex than the trade data, because we have two sides. We have a bid and an offer side. And we also have sizes for each one. And this is known as level 1 data, because we're focused on the highest bid and the lowest offer in the market at a given moment in time. And just as a side note, exchanges do supply this data so the public can see in the feeds what the best quotes are. But dark pools not necessarily provided in this particular stream. So this is the basis of what research and building models and analytics is really based off of these parallel streams of data. You can imagine quantities like returns, volatility, spread built on top of it. You can imagine building a multi-time scale approach to analyze the data. You do time series modeling, start to reason relationships between variables like volume and price, calibration, and event analyses, and all this good stuff is really driven off of this data. Now, as data scientists, we really do have to ask the question: well, where's this data coming from? What's the capture point, and what are we really getting here? And is it really what we're interested in? So the workflow for orders is actually quite involved from the time that a portfolio manager or trader decides to send an order. It gets fragmented due to, especially for large orders, it needs to get fragmented into many pieces, and ultimately gets routed out to the entire market, wherever the best quotes are at the time. So the data we actually see is the end result of a highly fragmented process. And in fact, we often need to reconstruct or work backwards to really understand questions like how much an order is going to move the market. But due to this fragmentation process and the output of the venues, the trade and quote data that we saw, we're really unable to do that to complete accuracy. So there's a lot of missing information here. So we have to be careful what kinds of questions we can ask and kinds of things we can do with this data, given the nature of it and the capture point relative to where it is in this process. Of course, if you're making a large order, like 100,000 shares of IBM, let's say, you want to know whether there's enough liquidity on the opposite side to maintain a stable order on this, to not blow the market up. And so that's really where the question of liquidity comes in, and order books. Since order books are where liquidity is encoded. We'll see more about that. So I'm going to make a very loose definition of liquidity. I'll say, and I'll read it since it's important. Liquidity is loosely defined as the market conditions allowing for immediate transactions at minimal cost, price uncertainty, and impact. So you can see in the schematic, there are different dimensions to what the dynamics are happening when transactions occur between the two streams of patient order flow, limit orders, and the aggressive movement and market order flow. So this definition really encompasses three basic dimensions. So there's a size dimension. So is there enough depth or available to accommodate the size of my order? So that's a very important question. There's also a time dimension. So clearly, if my systems are, or my broker systems, when in talking to exchanges with our orders, if the latency is off a little bit compared to the next guy, it may seem that liquidity is bad. Liquidity conditions are bad for you since the market looks like it's running away. You don't quite get the prices that you want. There's another notion here, which is resiliency. So when events occur in the market, trades and order flow, I'm thinking of in particular, the market reacts to that event and then responds to it. So there's a certain response time, which we'll call resiliency. So, for example, if a lot of liquidity is taken or spreads widen, then this takes a certain amount of time for the market to sort of revert back. So that's an important concept. There's also the price dimension. So obviously, you have questions about your orders and your executions. Did you get the price that you want? Why didn't I get the price that I expected? How much will I move the market? And so on. So these are three basic dimensions showed here in this picture. Now, many people use traded volume as a proxy for liquidity. I would say that's not the whole story. And in fact, we use some of the tools that we built here to show that during the pandemic crash in mid-March, we saw double the amount of volume traded, but the liquidity measured by depth, market depth, decreased by a factor of 10 to 20 times compared to pre-pandemic levels. So we might characterize that pandemic crash as a high toxicity or high volatility and low liquidity regime. So the fact that liquidity is not infinite leads to these effects like market impact, moving the market. And I just want to point out that liquidity based on these loose conditions is really not a completely known or observable. We don't know the exact state. So these are the constraints we're working under. Since there are many market participants, we can extend the notion of level one to a type of data flow to level two. Now, level two reflects many traders placing orders and so of course canceling orders, and there's different kinds of events that could be occurring across multiple price levels and sizing at each level. So we're dealing with a much more complex kind of structure, and I'm going to just skip to show you what that structure looks like. You see orders coming in, you see gaps between levels, you see buying and selling, and you see a special gap between the best bid and the best offer, which is called the spread. That's a special one. So our analytics that we're going to show you is driven off of this more complex structure. So we believe this is really where the visible market reflects the encoded liquidity at every given instant in time, is a more rich view of liquidity than simply looking at level one. Okay. So there are many challenges here. We have very high update rates. Liquidity shifts quite rapidly. You can have many tens of thousands of updates per second. The data, as mentioned, is a complexity there. So what we'd like to be able to do is visualize this data, reduce the complexity in a meaningful way through a suite of analytics that we're gonna show you. Other challenges is, well, how do we visualize this data without getting swamped in noise levels? There's always a lot of noise in this kind of data. Also, coverages, different markets have different coverages. Some markets trade much more fragmented than others. For example, futures market tends to be more consolidated on single exchanges, whereas equities tend to be spread out over many exchanges. So that introduces its own conceptual challenges and also technical challenges. Okay, move rapidly. So we believe that there's a hypothesis there that we can look at, which is we can improve the view of trading with at a relatively high resolution for not only traders to view, but also for feeds into execution algorithms that can benefit from a high resolution real-time representation of liquidity in the order book. So this will allow traders to reason a little bit better about current market conditions, make dynamic adjustments. If liquidity conditions look better, you might be able to accelerate your trading, or if they degrade, you would decelerate your trading. So there's the ability to dynamically update your trading rates based on these measures. And also, of course, post-trade, be willing to go back and ask the question, why did my order, or why did my customer's order slip badly relative to market? And so we can go back and understand what were the liquidity conditions at the time of the order, execution of the order. So we think there are some gaps there, and I think there's enough of a challenge that, that there's a sweet spot for this kind of work. So there's a tremendous amount of work involved. I'm not going to go through all of these things, but from analyzing markets, literature review, what would the product look like, where would it go, what are the use cases, who are the user profiles, what are customers saying about this kind of thing, what time scale should we use, what's the ultimate landing point. I mean, there's a tremendous amount of work in addition to developing the concepts, analytic concepts themselves. And so I'll also state my personal belief is a requirement for myself is to develop these things without dropping any data if possible, and make it as simple as possible, but challenging enough that it's going to be difficult for most players to be able to do this kind of work. So now I'm going to go through a suite of, it's not the complete set, but a few interesting measures we've developed. So the idea is that we would have a 1 second update rate, and within each second we would perform aggregations. For example, we mentioned the depth component of liquidity. So a very obvious one to do would be, okay, let's sum up all the liquidity on the bid and offer sides of the limit order book, and then calculate the mean of that per second, so you have a live feed of how much liquidity is available up to however many levels you want. Generally, we don't want to go past 10 levels. However, most people would believe that really looking at even the top 3 levels is enough to get a sense of what's going on in the market. Liquidity has a shape, so we can also do cross-sectional profiling of what does the relative distribution look like of liquidity in terms of how, as a function of how far it is from the best quote, or the best bid and the best offer. So some people believe that the shape of this object is important as liquidity kind of sloshes around. You can believe that if there's a relatively high liquidity closer to the best bid and the best offer, liquidity conditions could be interpreted as being better than if they're concentrated farther away from the best quote. So we've come up based on the depth concept. We also come up with concept around density, which measures not just the amount of volume, but the volume contained within a certain price range. So a large volume available, but in a very narrow range, means high density, good liquidity conditions, as opposed to a situation where it's more spread out, more sparse, and density drops. So that's really an extension of the depth concept. Of course, there's a tightness measure or uncertainty measure for price. So this one is quite well known. And as spread increases, costs start to rise, liquidity starts to degrade, since immediate buying and selling in the market becomes more costly. But we take it actually one step beyond. So we're going to go measure not only the spread, but how long does it take the spread to relax from a disruption, to go from a max to a min. So clearly, when it takes a long time, liquidity conditions are going to degrade, since you might have to wait a while for spreads to narrow before counterparties are willing to come back in. Liquidity I would say it's a relative concept, so it's not simply one aspect or the other. It's making and taking. So the fluid metaphor is quite interesting here. If you have a high take rate versus a make rate, the market starts to look more like a solid than a liquid. So that's what we're trying to capture here. There's also density of volatility. So one could convince oneself that if there's a lot of volatility in the order book, that is going to eventually show up in the price of the securities as volatility in the price itself. So there's a forward-looking view on that. And we can do very simple things, like we can not only look at a single security, but we can run cross-asset comparison of liquidity conditions across different securities. In this case, we have a futures and an ETF on the same index. So we can kind of get a sense of the similarities, the correlations, the synchrony between two very similar securities, and also the differences. So now I want to talk a little bit in the couple of minutes I have remaining. Everything we've shown so far is for single venue order books. As we mentioned, equities are fragmented across multiple venues. So it's less practical to look at the entire order book for so many different venues. One concept that we developed is a blended order book. So is it sensible to create a synthetic order book derived from prices and levels at best quotes, but across the entire market? And so if we take that view and we think it's an interesting thing to do, then we can start to look at questions like, well, how do we define the quality of execution? And also across venues, which venues tend to be closer to the best bids and offers in the market? In this case, the national best bids and offers, we're considering all the venues that's security trades at. So we can create things like heat maps. Let's see where each venue quotes tend to line up relative to the best bids and offers. And then we can compare that on the left to the actual executions in the market. So if your executions are occurring at venues which are very far from the best bids, then that's telling you that the routing systems that are being used are routing you to the wrong venues. So you're not getting the best prices in the market, which are guaranteed supposedly by regulations. So we'd be very interested in looking at these kind of tools for violations of that. In closing, we're also working on developing tools and measures for price quality. This one example we came up with, where we're looking at the relative range of price, the max and min trade price relative to the spread. So if you subtract that from one, when that number is positive, it's telling you that your executions, the executions in the market are within one mean spread. So that would be a good liquidity situation. If they start to spread out beyond a mean unit of spread, then there's a leakage, price leakage potentially. Executions start to go bad. What's the function of that? What's the view of that as a function of dark trading? These kinds of questions we feel we can ask. So in closing, I'd like to just say what's the future view. We'd like to use these conditions for not only modeling market impact. Most market impact models totally ignore these kinds of local conditions or immediate conditions. We think they're important. Also for predicting analytics in the near term, like volatility, we've seen very good, encouraging results using some of these measures, using machine learning to predict some of these measures into the near-term future, like, for example, volatility. I'm very encouraged by that. We're going to continue with analytics for fragmented markets, and then with new analytics needed there. And also, we're working very closely with our trade performance platform team to integrate these feeds into their system so you would have your order flow, be able to see your benchmarking and order flow alongside liquidity conditions in the market as they're occurring. So I think I apologize for rushing, but I think that closes out the presentation. And Natalie, if you want to take the poll question.
Thank you so much, Joel. We're going to skip over the final poll question, and there were a couple questions that came through, and I know we're just over time, but I wanted to get to one of the questions that a couple of the attendees had liked, and then we'll close it out for you. Joel, can you speak to what ways we are addressing sort of an alerting system for traders through your work?
Yeah, so that has come up multiple times in discussions with user when we've demoed our system to traders. That's come up a couple of times at least, and more than that. So we're looking very actively with our product and proposition people to develop concepts for alerting. There's also the infrastructure component. So we're building the infrastructure to create historical measures to allow for contextual analytics around sudden changes or regime shifts as a basis for alerting. So yes, that's very much forward on roadmap.
Great, thank you so much. You've really given us insight into the complexity of what it takes to look into liquidity, especially in the current market and in future markets. We're going to end there. Thank you, Joel, for your presentation, and thank you to everyone for attending. Once again, I'm Natalie Samarco from Refinitiv Labs, and we look forward to welcoming you next time to our next webinar. Thank you.
Thank you.